Hey everybody, it is Mark Jeftovic here from Spoken Tome Media. I am very happy to be able to present this conversation I had with the authors of the Zero Interest Trap. These are the same folks who put out the In Gold We Trust report, and the book has been out for a few months. We ran into delays with Amazon to get the audiobook out. It is finally out, and I'm very happy to be able to present my interview with Ronald-Peter Stöferle, Gregor Hochreiter, and Rahim Taghizadegan, and sit back and enjoy.
Well, I'm going to just do a quick intro. I'm here with, and I'm going to try to get the pronunciations correct, but Rahim Taghizadegan, Ronald Stöferle, and Gregor Hochreiter, who are the authors of the Zero Interest Trap. And it's a book about zero interest rates and negative interest rates, and we're doing the audiobook for it, and we have been talking for a few minutes waiting for everyone to convene, and here we are. So I'm in Toronto. Gregor, you said you are in Innsbruck, right?
Correct.
And Ronald and Rahim, where are you guys right now?
In Vienna.
Vienna. Okay.
I'm slightly outside of Vienna, so already Lower Austria. It's basically it's a suburb of Vienna, I would say.
Right. And Incrementum is based in Liechtenstein, right?
Yes.
Yeah. Okay.
Which is, Austria looks like a bit like a schnitzel.
Right.
And Vienna is on one part of the schnitzel, and Gregor is close to the other part of the schnitzel, but Liechtenstein is like at the very end of the schnitzel.
Right. So I know you guys put out the In Gold We Trust report, which I read every year. It's a great resource. What prompted you or motivated you guys to write the book specifically about zero interest rate trap?
If I may start,
Absolutely.
Well, we're writing the In Gold We Trust report for 14 years now. I started publishing the report when I was still a young analyst sitting in the bank, and at some point I felt like the vegetarian being in the butchery, because being pro gold and sound money and working in a bank, that's it's not always easy. So at some point we set up our own company in Liechtenstein, but we continued writing about gold, and we met Rahim and Gregor through our studies of Austrian economics. So me in that case is my partner Mark Walek, and yeah, we studied at the institute and learned more about the Austrian School of Economics that is unfortunately still hardly known over here in Austria, and therefore it's good to put the word out and trying to educate people about the ideas of the Austrian School of Economics. And we wrote a book together with Rahim called Austrian School for Investors: Austrian Investing Between Inflation and Deflation. And it was quite a
book. I didn't realize
Excellent.
That was you guys.
Yes.
Okay, great.
And that was really a big success. So at some point we said, let's do another book, and Gregor joined us, and I think the timing was really spot on. And there's still I think that publishing a book is still something different than compared to studying publishing a report. So for us it's been lots of work, but also we really enjoyed putting together this book, and very happy that it's such a huge success in the German speaking world and also in the English speaking world.
Great. Well, that was a pleasant surprise, because one of my questions I did want to actually talk about was the tug of war between inflation and deflation, and you covered that a lot in that other book. So can you talk to us a little bit about why do governments fear deflation so much, and why is it inflation at any cost, and it's sort of taken to be a good thing unto itself to have this targeted just right level of inflation for, that's really degrading our currency year after year?
Well, if I may take the lead in answering these questions, first of all, one has to mention that the European, when it comes to the Eurozone, the European Central Bank has a very narrow monetary policy goal, which it's hierarchical in contrast to the goals, the monetary policy targets of the Federal Reserve System. So the European Central Bank, first and foremost, has to control inflation, which means close to, but below 2% over the medium term. So from this perspective, as inflation is rather low, the European Central Bank is stuck in an inflationary policy, meaning in a policy which expands the money supply as long as the inflation rate is below 2%. But another reason is, and especially in the Eurozone, but not only in the Eurozone, is for keeping interest rates low, is that, of course, as government debt increases, the lower the interest rate as set by the central banks is, the lower, at least in the short and medium term, the yields on government bonds are, which of course has a direct effect on the deficit or the expenditures of the government. So the zero policy, the zero interest policies of central banks, or the low interest policies of central banks in the last years, has had as a consequence that budget deficits were lower than they would otherwise have been, or in the case of Austria and Germany, governments were able to reduce at least the debt levels significantly by the help of low interest rates. So, and if interest rates would rise significantly, of course, this development would change by 180 degrees, which would put enormous pressure on highly indebted countries. For example, the US, but also in Europe, then Italy, Greece, and I think a country which manages to keep out of the public debate for most of the time, which is France, which has almost, or which will surpass the 100% level, debt to GDP level this year. And of course, these are also governments which have problems of also political problems, which they try to solve by ever expanding their expenditures, which cannot work for a long time. So they have an enormous interest of keeping interest rates low. And in the European central banks, not even Germany has a permanent seat on the ECB Council, which is responsible for monetary policy decisions. So the countries with excessive deficits or debt levels have a majority now in the ECB, which of course fosters a low interest rate environment, or supports a low interest rate environment.
And we talked a little bit about this before everybody was on the call, but once you're at that very low interest rate environment, if we look at Japan, it looks like they've been stuck there for 30 years. I mean, is that a precursor of where everybody else is going to be now that we've all touched the zero bound? That we're all, everyone is kind of stuck there and is kind of precluded from normalizing as long as they keep expanding their debt levels?
You want to go? Okay. Yes, I think so. I mean, as the general direction, what I think is unlikely is that we'll be stuck in there as long as Japan has been stuck there, because there's some general differences. Europe is much more heterogeneous. The US as well is more heterogeneous. There are more conflicts within society, which make it much harder to go that way. But the challenges are similar, in particular between Europe and Japan. There are demographic challenges, and then, of course, the debt of finance development that we have with lower and lower returns on investment going on. So the direction is the same, but I think the trap will look different in Europe and the US.
If I may add regarding Japan, we should not forget. I think we're showing that in our recent In Gold We Trust report. They already had 23 or 24 rounds of quantitative easing. So you might ask yourself, why didn't it really help? And then the answer is probably because they didn't do enough. So next round will be even more. So I think there are similarities, and also if you study Ben Bernanke's work, his scientific work focused first of all on the Great Depression, but also quite a lot about Japan, and he tried to avoid many mistakes that the Bank of Japan made by starting with the first round of quantitative easing at a much bigger size compared to the first round of QE in Japan. I think if we follow the situation and if you compare the situation, Japan versus Eurozone versus the US, I think there are many similarities nowadays. And if we have a look at the answers and the solutions or the measures that were taken in the whole COVID crisis, we can see that the size of monetary and fiscal stimulus was roughly the same. But in Japan, fiscal stimulus was even bigger than in the Eurozone. It was roughly 30% of GDP already since the COVID crisis hit. So probably, we came to the end game much closer, and from my point or from our point of view, deflation will not be the final chapter. From our point of view, it will probably be a currency reform. It will be inflation. So I think it makes totally sense to study the case of Japan, but probably we're going in the same direction, but at a much faster pace.
I mean, I've always thought of it like almost before a tidal wave comes in, the water tends to recede. So I've sort of thought of deflation in those terms. It's the deflation before the inflation comes. I was about to ask a different question, but you triggered a different question after that. Is it possible that anyone is going to go hyperinflationary? Is hyperinflation a possibility? I mean, I know these things are impossible to predict, but is this something that should be on anybody's radar, or is hyperinflation just tinfoil hat material?
I think it's much more likely in developing countries where you have a lot of debt is held outside of the country. So that usually was the main trigger for hyperinflation. So I think we'll see hyperinflation first, and we've seen signs of hyperinflation, of course, in the developing world. Then seeing that in the Eurozone and the US.
Right.
Yeah, I think that from a technical point of view, it's not a problem to reduce the monetary supply at a quick pace, but hyperinflation is in the end a trust issue. So hyperinflation sets in when the population at large loses trust in the currency or in the state. I mean, these are things that they go together. And this is the question whether this will happen. I mean, this is something you cannot predict as such. But when I talk to friends of mine or to my family who are not economists, they ask me what will all this lead to, and it's a rhetorical question because they answer themselves in the sense of hyperinflation, meaning at least a significantly higher inflation rate as we have now. I mean, I think people sense that the economic consequences will be enormous and much more than now the statistical figures we read in newspapers. But when it comes to day-to-day experiences of what a reduced well-being or reduced wealth means. And one must not forget that even though inflation rates are now we have a disinflationary phase again. If you look at more closer, you see that prices for food, they increase at an accelerating pace. I mean, in the United States, we had in April, I think, the highest increase year on year in the last 46 years. In Germany, we see the similar trend, and the only reason why we have a disinflationary phase now is because of energy prices. If you take energy prices out, inflation is already, I think, above 2%, above the 2% level, which is important for monetary policy decisions. So, and we have inflationary tendencies, of course, on the stock markets. I mean, I think it's more or less insane how stock markets have developed in the last weeks. I mean, they're not insane if you see what governments and especially central banks have taken or have how they have inflated the monetary supply. But still, the stock markets seem to indicate that the worst things are over. And I think that's only the reason because the additional money supply has gone to the stock markets to a large extent. And this will, of course,
if I may also add, first of all, we're getting emails and phone calls by clients and potential clients, but also by journalists regarding the topic of inflation at a much higher pace than a couple of months ago. So it seems that there's a big concern coming up regarding inflation, and that people kind of sense that inflation might be not around the corner, but at least on the horizon. Then I think that the longer, Austrians tend to have a different view on inflation. So from our point of view, there is already massive asset price inflation, obviously, real estate prices, equity markets, the art market, bond markets, of course, trading at ridiculous prices. So if you talk to a central bank, he would say there is no inflation. There is actually a lack of inflation. We would say there is inflation, there's massive inflation, but just not in those economic aggregates that you follow. And I think now with those extremely aggressive measures that were taken, both from central banks, but also from the fiscal side, I think the longer we have falling inflation rates when it comes to CPI and PCE, the longer we have this disinflationary, deflationary pressure, the more leeway central bankers will have to put out even bigger numbers, and nowadays if we're talking trillions, that's nobody's worried about that anymore. I can remember in 2008 when a British mortgage bank was basically supported or rescued by the government, and it was a big outrage, and the Financial Times said, you cannot do that, that's the end of capitalism. That was 50 billion British pound. I mean, 50 billion British, that's peanuts nowadays. So I think if we talk about the trigger to a highly inflationary environment, I think it is really this interconnection between monetary and fiscal stimulus. And now with ideas like MMT, like universal basic income, like helicopter money, yield curve control, all those things that were just theories a couple of months ago, I think it's pretty obvious that those policies will be implemented. And I'm not sure about the elections in the US, but if Democrats should win and perhaps they should even have a sweep, then I think the likelihood that there will be extremely aggressive fiscal measures will be taken, I think it's even higher. And I think this then might really be the trigger in the direction of higher inflation rates compared to the previous phase where we only had basically quantitative easing that fostered mainly asset price inflation.
Your responses took me back to the original question I was going to ask about all this, because I think it was Rahim mentioned that the lower and lower returns on investments, on bond yields and that sort of thing. So that for years, I mean, since 2008, that was incenting people, or sort of chasing them into higher like out the risk curve to kind of get that yield. I mean, I remember my mom was a pensioner. After my dad died, she just had all of her savings in bonds and GICs and things like that. And, you know, she stayed in them, but all of her friends, whenever one of their husbands would die or something, the banks would come and say, put all this money in the stock market. You're not going to get enough yield on fixed income to live on. And some of them did it, and to their chagrin, if it happened before 2008. And so we've had this dynamic for, call it 9.5 years, up until, you know, the beginning of this year, where you're getting chased further out the risk curve just to get what you think is a reasonable return on investment. And of course, we all agree that the rising asset prices are a form of inflation. Not everyone, you know, Paul Krugman doesn't think that, but everyone on this call thinks that. But now I think there's another dynamic to this, whereas not only are you going to want higher returns because you can't get them from fixed income, now I think there's this new awareness that cash is going to lose purchasing power. So you want to move it into anything other than cash. Like lately, I've been moving, you know, my cash balances. I'm like, I don't want to leave it in cash anymore. I want to move it into like bullionvault.com or gold money or places like that. And I stopped thinking of gold and precious metals as an investment. And I made this mental shift where I'm saying, this is my liquidity. This is my savings now, because I'm just moving my cash from this instrument to precious metals, because I think, you know, a loss of purchasing power with all this inflation, all of this money printing, and even the prospect of bail-ins and things like that happening, and wealth taxes. So, and that kind of brings us to the whole section in the book, which I found was quite fascinating, of the social consequences of zero interest rates and negative interest rates. And it drives everything, including, you know, political correctness on university campuses. Do you want to talk a bit about that, Rahim, perhaps?
Sure. I mean, the Austrian business cycle theory is focused on misallocation of capital, and that means that the whole production structure gets distorted and deformed. And by consequence, that must mean that the whole production structure, and thus also the structure of society, does not confirm or confirms less and less to the preferences or long-term preferences of the population. So you have more and more jobs and structures within a society that are further and further away from that kind of reality, where you see the market as a kind of reality check if something conforms to the long-term preferences of the consumers and the savers and the investors. So thus we've built up kind of bubbles all around the place, and we see similar developments and structures. And of course, one of the obvious bubbles is the education bubble, in particular higher education. But it's now sometimes even linked to career bubbles, to so-called bullshit jobs, where you go on from one cocoon to the other cocoon. And it's a kind of cocoon phenomenon. So I don't think those filter bubbles have emerged due to the internet or social media. I think in contrast, we are now much more and more aware how those bubbles conflict and crash with each other. It's more or less a sign of how those bubbles could have developed. So more and more people are surprised that there are alternative realities out there, alternative perceptions out there. And it's quite odd that you can grow up and get old, and then suddenly you find that the world behaves very, very differently to what you expected it to be. And there was never really that check. There wasn't really a correlation between your capacity to earn income, your capacity to even have good investment results, be good entrepreneur, with really being linked to reality with your predictions, your anticipations, your assessment, your skills even. So I think it's fundamentally this problem of bubbles arising as a side effect of the whole bubble phenomenon, which is distortion and deformation of the production structure.
You know, in a separate podcast I was listening to the other day, a guy who you may have heard of, I don't know what your thoughts are on him, Max Kaiser, introduced me for the first time to the concept of interest rate apartheid. You know, he said there's the people who can borrow $1 billion at 0% interest and then either just do a carry trade, because even at, 50 basis points, you're making your zero risk money, or they can buy back shares of companies that they own and just drive their own investment results in, while everybody else in the world who's not connected to that financial spigot, well, they have to pay 20% on their interest on their credit cards, and it almost seems like there's this moral hazard there where the people who get to borrow this money risk-free and enter into risk-free trades for large amounts of money get bailouts when the times get tough, and everybody else who has to pay full pop, higher interest rates on their capital, they have a higher cost of capital. When their small business goes under or their job gets eliminated, it's like, well, that's tough luck. That's how capitalism works.
Yeah, that's a huge problem. I mean, there's a redistributional effect by constant central bank interventionist programs. That's not capitalism, or that's not, I would even say, common sense life. I mean, if things go right, you are applauded for your skillfulness and you get all the monetary return. And if it goes wrong, then you are rescued by essentially a state entity, or at least an entity which has significant privileges granted by the state. And I think we should also stop in public to promote these institutions or these people who are lucky to receive these rescue packages as being business role models. I think there's a point, if you want to make a political statement, where the political left has a genuine critique of the current setup of how capitalism, or so-called capitalism, works. I think it would be, in any society, I think it's very important in society that people can learn from their mistakes. So, if you make a mistake, you should not, and you should not be despised, or you should definitely get a second chance, but it should not be the case that you have this on an institutional basis. And it's also funny that most of these people who receive these rescue packages, they are not entrepreneurs, they are managers. So they're employees employed by corporates. So, this is also a completely wrong perception in a society which is perpetuated by media, but also by those people, if managers are invited to talk shows and are portrayed as entrepreneurs, which they are not. So I think that there is a huge problem, and what we see is this interventionist spiral. So the answer to this wrong policy should not be more redistribution, but less redistribution in the first place, by not granting these excessive rescue packages.
Sorry, go ahead.
So in a certain respect, we agree with most left-wing observers that inequality is increasing and that it's a problem. And we really try to show how a lot of the polarization in today's society, which you now live in the United States in particular, but of course we have very similar issues in Europe, has finds reasons and causes within the monetary distortions. And I think that's really important to understand because it helps you to understand a lot of the conflicts and misunderstandings in politics right now. And to add, the problem of interest rate apartheid seems to be even worse in China. So it's not a particularly Western phenomenon. It's a general way of development, which I think leads to counter reactions as well, and kind of reactionary left-wing, right-wing reactions that go against globalization, for example. I think a lot of that is a reaction against this certain kind of development where I would agree that it's not always going in the right direction because the distortions are increasing.
Yeah.
If
Go ahead.
I may briefly add, I think when it comes to inequality, we know all those indicators like the Gini coefficient, and right before the Great Depression, this gap between the wealthy and the poor was as wide as it is now, basically. And then came the crash, and I have read that most of the losses were actually not caused from the stock market, but rather in the corporate bond market, where people lost most of the money. But the result was that back then we were on a gold standard, so the Federal Reserve couldn't just print trillions. That this gap between the rich and the poor it shrunk. Now in 2008, we would have seen the same development, but of course the Fed tried to bail out everybody, and now we saw that they're even getting active in the corporate bond market, in the junk bond market. So that's basically the next stage. And from my point of view, it's at some point they will also buy stocks. I think the Swiss National Bank is doing that already. The Bank of Japan is doing that already. I think at some point they will bail out the stock market as well. And of course, this creates even more moral hazard. And therefore, we once said that, if you remember, the Occupy Wall Street movement, I think that was like 2011. It was a rather peaceful movement, so there wasn't real violence involved, and we said, over the next in the course of the next recession, Occupy Wall Street, something like that will happen again, but in a much more violent way, because this gap between rich and poor has grown even further. And I think, all this violence that you're seeing now in the US, and it's not only in the US, we saw very similar developments in many other countries. That's also a sign that people are just frustrated, that they cannot make ends meet. And from our point of view, and this is really important always to tell people when you're talking with, let's say, rather left leaning people, let's talk about the real the real causes, the root cause of this inequality, and then you end up in our monetary system, and probably in 1971. So for us, it's really important to talk about the real causes for this inequality, and not just about the symptoms and how to redeploy capital, but only find like very short-term solutions.
That was one of the things that made this book so refreshing, because I've been trying to enunciate this to people who are talking about structural inequality for a long time. You guys probably know the book, Steven Zarlinga, The Lost Science of Money. Maybe not, but he wrote a history of money, but he basically came down to one thing. He said, whoever controls the monetary system controls society. And so when people talk about structural imbalances or even racism or inequality, I always try to gently say, look, it's the money system. If you can control the monetary financial system, you control society. If there's a structural systemic inequality in there, it's in the money system itself. And that was another thing that Max Kaiser said, is he said, forget talking about redistributing wealth. What we have to redistribute is risk. And I thought that was such a succinct way to put it, because it brings us back to the people who can borrow risk-free billions and be bailed out versus the people who can't, who don't get bailed out. That's kind of the dividing line right there, and now to your point, and it kind of brings us back to modern monetary theory, which you guys, and which you called in the book magic money tree. I rather like that, because that again is glossing over the fact that this structural inequality in the system, which transcends racial divides, it transcends race, religion, ethnicity, all of that stuff. It just it delineates down to who is close to the Fed window or the central bank window and everybody else. But then when you try to trot out something like MMT and use it to finance UBI, then suddenly you're back to just tweaking knobs on this superficial thing that is not really changing the structural inequity of society, because you still have this group here who gets to create value out of thin air, and this group over here who basically experiences all asset inflation as a rising cost of living. And that leads to that unrest.
Yeah, well, I think the analysis of MMT, guys, is not that bad, but that's mainly for the reason that the world has changed so much to confirm to their bias, basically, or their perception how a monetary order would be in the end. And of course, they think that their solutions are addressing inequality in particular. That's why they want to democratize money creation. But where I'm at fault with that is, I think, is generally this naive picture of politics. What we've seen so far is that in politics, you've always had redistribution and increasing redistribution, but in the end, it had only increased the structural inequality, because as long as you can anticipate politics and as long as you have the right levers and connections and so on, of course you're at an advantage. And we've seen the same thing with all these interventions right now. And of course, the MMT solution won't be any different. I think it's pretty easy, and we tried it in part in the book to anticipate who will benefit the most from like going full away MMT, and obviously it won't be the small guy.
Right.
But what is very seductive of MMT is that one thing MMT claims is that the problems, however you define the problems, can be solved by increasing the money supply and not by increasing capital through saving, and by increasing ideas, meaning that you need to have the best brains to work hard on solving technological problems, for example, when it comes to a better use of resources and so on. And that's I mean, you can take I like to boil down complicated questions to everyday life. And of course, it's very seductive in a family to say, if you have a problem, the father or the mother nowadays says to the child, here you have my debit card, go shopping. So, but you cannot solve problems which might be existential or when it comes to technological problems by simply printing more money. You have to tackle them on the respective level. And MMT says, if we can, in a simplified version, if we can print more money, we could finally live in the utopia, be it a green utopia, be it a utopia of equals, be it a utopia where everybody gets immediate gratification. So there's also, I think that's a very important topic which also comes up with social unrest, that the idea now is very dominant that you do not have to work for a goal, to achieve a goal. So to have immediate gratification is something which is very seductive, but of course life does not work that way. And I think this is on a psychological level, a very problematic aspect of MMT, that it seems to solve the problem that if you want to achieve something, you have to work for it by simply printing more money.
Well, you in the book you discuss how these policies actually lead to an increase in narcissism, which is what we're talking about here. This belief that we don't have to work, we can have instant gratification, and what we want in our immediate desire right now is all that really matters. And because we have MMT, there's nothing that should stop us from getting it.
Yeah, definitely. I think you can define narcissism as being very much focused on the present tense and, of course, your small bubble where feeling good is all that counts. And that's generally the kind of approach that's rewarded in this kind of monetary order. So it's not at all surprising that narcissism would rise. And it links, it's very closely linked to the phenomenon of cocooning of bubbles that I mentioned before. So you're protected for long times of your life from feedback from potential real customers, clients, investors, and so on. And then when suddenly you get, maybe through the internet, some of that feedback, some of those alternative realities, it's really shocking to you and you can't cope with it. And you don't see it as an invitation to learn and to change, because that, of course, would endanger your feeling good at the moment, at the present tense. Because learning, changing is always a long-term endeavor where you take some kind of costs up front, and then there'll be an uncertain reward in the future.
Speaking of alternative realities, I wanted to touch briefly on cryptocurrencies and Bitcoin and blockchain as another defensive strategy alongside precious metals amongst all this. Did you want to weigh in on that at all? You do mention it in the book.
Yeah, I think it's becoming more and more important because, of course, more and more people realize that there's this asset price inflation going on. And so it's really on the radar. And what people are looking for, if they understand the problem, it's uncorrelated assets. So it's really hard, even just to keep liquidity. Of course, you want to get out of this cyclical volatility, which you're exposed to and which doesn't help you cope with uncertainty. Which everyone has to do because we're getting older. So it's a basic need that we have as human beings to have liquidity to cope with that uncertainty of the future. So looking for uncorrelated assets, I think that's how investors have happened to come to the subject of cryptocurrencies and Bitcoin in particular, due to the network effect. It's the oldest, the longest track record. Alternative digital asset, where there's a promise that it might be counter-cyclical, and of course part of it finds ideological reason in it. That's a lot of the people involved with Bitcoin seem to be contrarian, and it seems to be similar to the gold scene, a lot of contrarians there. So of course that's a sign, a political sign of something being potentially counter-cyclical and uncorrelated to the other assets, which means if everything else comes down crashing, it may be assets that just win by standing out. So I think that's the main reason for investment interest in something so abstract and bizarre to most people as a digital ledger like Bitcoin.
I think it is no coincidence that Satoshi Nakamoto published the white paper. Was it already 2009 or was it end of 2008? Rahim, you probably
believe
know
it was 9.
9, yeah. So it was probably the answer to the great financial crisis, and therefore I think that whoever Satoshi Nakamoto was, he clearly understood the flaws of our monetary system. He understood gold, and he understood relative supply curves. Because from my point of view, this is where it all boils down to. It is the relative supply that is much more stable with gold, but also with Bitcoin. We saw the halving in May. So basically, the inflation rate of Bitcoin is the same inflation rate like gold's inflation rates, which is 1.6% per year. And in 4 years, it will be half the inflation rate. So I think if you understand this concept of stock to flow ratio, you understand gold, and you will probably at some point also understand Bitcoin. and therefore we're quite open to the idea. We're open to when it comes to competition, of course. And why shouldn't there be any competition when it comes to currencies? So we launched a fund that combines digital gold with physical gold, which is a from our point a great combination. So we're very open to this idea, and we see that there's lots of resources, and by resources I primarily mean human resources, moving into this market. Really bright, young, ambitious people that only see opportunities, that really want to develop and offer better solutions to the market. And therefore, I think, there's lots of flawed business models out there in the crypto sphere. There's lots of rubbish altcoins and so on. But I think that the direction this is leading is fantastic, and therefore I think that Bitcoin is definitely also one of the answers to this monetary madness that we're seeing at the moment.
Just quick correction, it was October 31st, 2008. So
Okay.
Halloween night that the white paper came out. We're coming up to your hard stop. So I have one last thing that I sort of ask philosophically or rhetorically. And a friend of mine who's sort of a retired tech CEO, we were having lunch before this entire crisis began, and we were kind of ruminating over the irrationality of the financial markets. And we hadn't seen anything yet because they were about to get even crazier as this coronavirus hit. But we were asking ourselves, are we the nutcases? Can this go on forever? Like if people like you stop writing these books and people like me stop blogging and talking about it and everyone just continues to believe, then can a low interest rate, ever expanding money supply just print money when we need it and keep everything under wraps and under control? Can't we just do this forever and everything will be okay?
Well, I mean, human beings are able to live in fantasy for a long time, but then I think in the very long run, of course, we are material beings. That means we are living in the real world, and I think there are just trade-offs to see, and you can't have everything. So I think trade-offs are not only an economic concept. I think it's really built into the space-time structure of our world. Thus, I believe that this kind of reality check will always be out there in the long run. You'll be able, as a human being, with a lot of mind spins and so on, to downplay these ruptures and to somehow fix or seemingly fix problems arising, but only at the price of other problems arising in a different field. So in the long term, I can't see it happening without a tremendous change in human nature, which might even make us not human anymore. So of course, if you have robotic people, apathetic people, everything is possible, but then it's really senseless to ask the question in a philosophical way. So with not thinking that human nature will change tremendously in short time, I don't think it's possible. So even without us writing books, and maybe it's even overrated to write books, I say it as an academic myself. I think it's just what we try to do is understand what's going on, but we are not at the levels of what's really happening. We don't know if we are really agents in what's happening right now. In particular, it's usually change is affected by trial and error, and then seeing someone better reaching his ends and learning from role models. And I think they'll become more and more important, because you don't only have individual role models, you can have regional role models, you can have certain parts of the world coping better, certain technologies being better able to reach our ends. And among those technologies, of course, you have to count monetary technologies as well. And the technology doesn't have to be something very fancy. It can be something very old as well. It's just a means to fulfill certain ends. So in the long run, I'd say I'm optimistic that human beings are able to learn, and institutions can be changed and structures can be changed and readjusted to our real preferences.
Yeah, I would also say that over the long term, you cannot trick the price mechanism. You can try to find a scapegoat as a society if things don't work out as you believe they should work out, but if they do not conform to reality, then somebody has to pay the bill. I mean, it all boils down to that, and I don't mean this just financially. Also in life, somebody has to take the risk. Somebody has to till the soil. Somebody has to do the harvest. And if you don't accept these basic facts, things will run differently as you believe, and then society starts starts looking for scapegoats. And of course, you can extend this to a certain again, and to even more groups, define them as scapegoats. But this is not what a society, or at least a civilized society, is. I mean, you can sacrifice human beings if you believe that this improves the weather. But still, this is not a society anyone wants to live in, so people will also react to this cruelty, and this has happened also again and again. And I think if you want to live in a humane society, you have to accept certain realities, and this is how, in the end, also a society prospers, all economically, but also culturally, socially, and which makes life then worth living. I mean, living in hell on earth is not a life anybody is striving for.
Okay, well, this has been a great talk, and we're coming up to the end of our time. Do you want to, the book is going to be, it's already on Amazon now by the time I get this video up. The audio book any day now, look for it on Audible and iTunes. Do you want to let us know, or whoever's watching, how to connect with your website, your fund, that sort of thing?
Well, we have different locations. So I'm running the Scholarium in Vienna, which institute that tries to really keep alive the Austrian School of Economics in its very original sense, in its very interdisciplinary sense. So that's scholarium.at, Scholarium, SCH. Ronnie?
We've got Incrementum based in Liechtenstein, where we're managing funds and do wealth management, but we also publish research. It's incrementum.li, or for the In Gold We Trust report, it's ingoldwetrust.report. And yeah, I'm also quite active. Oh, quite active on Twitter. My handle is @Ron-Stöferle.
Okay.
And I'm self-employed, so the easiest thing to get in contact with me is by Googling my name. My email address is Gregor.Hochreiter I forgot my own, ökonom.at. But you find it if you Google for me. There's only one Gregor Hochreiter as far as I know.
Okay, and I'm going to put all of these links into the show notes page for this episode. So again, thanks for coming on, and stay safe, stay sane, stay healthy over there, and looking forward to doing it again sometime. Okay.
Thanks for having us.
All right.
Thank you very much.
Take care, guys. All right. Bye.
Take care. Bye-bye.